It's one of the biggest purchases of your life. Home ownership remains at its lowest level for a generation. It's become even harder for people to get onto the property ladder. Decades of slow growth in wages has meant for first-time buyers, costs about 9 times earning in London, or about 5 in the rest of the UK. But is renting such an issue? Are we in the UK obsessed over owning a home at all costs? As a society, we seem to be moving more towards valuing experiences, so is it worth giving up all your freedom just to say you own a home? Is this an outdated view that's no longer relevant in 2021? With so much to consider and it being probably the biggest financial decision of your early life, it's never been a better time to take a step back and think, rent or buy. Hi there, my name's George Agan, I'm a chartered financial planner. So I'm going to be going over a bit of background first, which I think is going to be really important to help think through the conclusions at the end. Now, just a bit of a disclaimer to add to the normal ones. You can't accurately summarise the property market of an entire country without making some big generalisations. So I'm talking big picture, macro level here, but it's equally important to be aware this is going to be a very specific decision, so you're going to obviously have to do your own research. But with all that said, is there a supply problem? It's common knowledge that the simple reason for the UK housing boom is that there isn't enough to go around. It makes sense, right? Well, maybe not. In the paper from the UK Collaborative Centre for Housing Evidence, they said that since 1996, the number of households in England has averaged about 147,000 per year, while growth in housing stock has gone from 168,000 per year. There's similar stories in Scotland and Wales. While anything on the national scale, there'll be areas that go against the trend. It does seem we're creating enough housing stock. Now, that does not mean we have enough affordable housing, as that's completely different. But have you noticed that rents haven't really been increasing that much? Sure, you'd think that if it was just a story of supply and demand, we'd see both property prices and rents skyrocket over the last decade. Well, the truth is that hasn't been the case. Using the ONS stats, rents generally across the country have struggled to keep up in line with inflation. While property prices have soared, rents have remained pretty flat in general. So something isn't adding up. So what's driving the boom? Well, this is a really interesting topic. So what's going on here? And why is there such a difference between rent and housing prices? Doesn't make much sense. They're both products of housing assets. While there's a bit of debate across experts, it kind of comes back to asset pricing theory and interest rates. So why should you care about interest rates? Well, for one, that's what your mortgage payments are likely linked to over the long term, which will affect the cost of your payments. But also, it's because the interest rates are the tide that lifts all boats. The reason why central banks lower interest rates is to stimulate the economy. Interest rates are very low right now, but that's not the norm when you look back at history. Why that matters is that when money's cheaper to borrow as interest rates are lower, it reduces the cost of capital and to buy. But not just for you and me, for everyone who's creditworthy, including possibly wealthy investors, which will make it generally easy to finance purchases, which increases competition. Biggest factor though, which is a bit of a dive into asset pricing, lower interest increase the present value of any cash flow on assets. So what that means is that an asset has a cash flow, be it rent, coupon or company earnings. Those asset earnings are discounted to factor in that cash flow is going to be paid over a long period of time into the future. And if that discount rate is lower, the capital value increases. I've linked below to a Bank of England blog which explains this in a bit more detail. So this blog post says, we find that the rise in real house prices since 2000 can be explained almost entirely by lower interest rates. So why does that matter so much to think about? Well, we don't know if interest rates can continue to go into negative. It's been tried in Japan, Switzerland and Denmark, but if it's true that rates won't go much lower, which is an if, not a certainty, then one of the big tailwinds for house price growth could be out of ammunition. Now, does that mean it will happen or rates will go the other way? No, it doesn't. It's just a simple fact that the economic environment you're in now is not that of the last 30 years. Now, there is some expert debate over interest rate position, and I definitely agree that it's not just interest rates which affect house pricing, but clearly is a big factor. So it's good to think carefully on the commitment, which, to be honest, regardless of the economic environment, remains a very good starting point. So can you really compare? So I think the thing that isn't really talked about enough is how different the experience is between these two options. Renting is not growing your net worth, but you are buying freedom, and depending on where you are with life, that might be the best financial decision for you at the time. Almost certainly a house is likely to grow your net worth as you're exchanging some of your monthly payments for equity in the property. But there is a lot more that could go wrong. Carl Richards, who wrote The Behaviour Gap, which I mentioned in The Biggest Risk to Your Investments, mentioned that properties can often be one of the best investments because it's a forced investment. There are consequences if you miss your mortgage payments. And that means that the asset can compound in value over time, which is really where the magic happens. That's why I think you have to take any calculation with a bit of a pinch of salt. Ben Felix has done a great video, which I'll link in the description, if you want to do a calculation against buying, against renting and investing. But from a financial planning perspective, I'm not quite sure that decision can be made being 0.5% extra, more or less in growth. They're so vastly different experiences and responsibilities. On one hand, some see rent as dead money, but I think that's quite poorly framed, because if the choice is intentional, you could argue that you're paying for freedom, which, you don't get to build your net worth over time this way, but you can up and leave relatively easy. You've just got a cost to lifestyle flexibility. On the other hand, buying, you can build your net worth over time. You're owning something, but there are strings attached. Moving house can be incredibly stressful, it's costly, you now have a long-term obligation to pay a mortgage, so the ability to make big life changes might be reduced. I also mentioned this in understanding your investments to consider concentration risk. On a personal note, this was really reinforced because after the tragic events at Grenfell, there are about 700,000 people who are now living in what's considered dangerous conditions due to cladding. And actually one of those buildings which has now got the cladding issue, me and my partner were looking at. So it just goes to show that even sometimes when you don't think about it, concentration risk can kind of rear its ugly head. And I can't imagine what it would have been like to have been landed with a huge cladding bill as soon as I just bought a property. Now, this isn't to put you off buying, as it can often be a great idea. It's just trying to be balanced, that if you get the rewards, don't forget the risks. So what you need to know, the cost of buying. You've got valuation fees up to about 700. You've got mortgage fees and charges up to 1,500. Property survey costs up to 1,500. Conveyancing fees just under £1,000. And then removal costs. Well, this can really vary, but it can go up to about £1,500. Then you've got stamp duty. Now, this has changed a lot due to the pandemic, but it works on a tiered basis. There are exemptions for first-time buyers, as well as increases of stamp duty if it's your second property. So this video doesn't get too long. I'm just going to put the current rates up now, and you can freeze the screen if you need to focus on this. There is also a stamp duty calculator in the description which can help you. So what you need to know, how a repayment mortgage works. So assuming you have a repayment, or also known as capital interest mortgage, one of the things to bear in mind is that in the early years of paying off a mortgage, you are paying a higher proportion of interest compared to the capital, as the interest that's being applied is on a larger overall value. Now, this changes over the years as you pay it down to a much smaller amount. Well, why does this matter? Well, again, it comes back to life stages and the trade-off between buying and renting. If you're, say, buying a property that you need to move in a few years, you've got to then, factor in the cost of buying and selling, and considering that you may not also have as high an equity level because of that particular structure. And also, it will obviously depend on the big unknowns, which are house price growth. But it just comes down to running the figures. There's a calculator in the description so you can have a play with the figures. So what you need to know, the government support. Okay, so there are two main schemes to be aware of if you aren't already. The lifetime ISA, you can contribute towards a house purchase for first-time buyers. The maximum contribution is £4,000 per year, which is part of your overall £20,000 ISA allowance. The government tops up £1,000 on top of that. Both you and your partner can have a lifetime ISA if you're both first-time buyers, and you need to be between age 18 and 40 to open one. There is, however, a penalty of 25% on any withdrawals if it's not for your first home or retirement. So the Help to Buy equity loan scheme is where you can borrow from the government to fund a purchase. Again, links in the descriptions, but just remember with this, it's an equity loan, so the government will own a share of the property. And should the property value increase, so will the amount you have to pay back. So final thoughts. This decision is inevitably going to be really specific to you, but hopefully all of this has given you some food for thought. Both buying and renting can be great decisions when done for the right reasons. But I think now more than ever, it's worth making sure you're intentional what is a big financial and life choice. I mentioned in the episode Making Better Decisions about trying to consider yourself over time when reviewing a decision. And this is a great example. So as a combination, you can first think about yourself over time when you view the commitment, and ideally, if a purchase is one that you'd be happy there in 10 years, there's a much higher likelihood it's going to work out. This is especially important now as people are buying in later life, so maybe in different life stages. And remember, a property is ideally a home first and an investment as an afterthought. So actually take some time to run the figures so you're in an informed position. And then finally, just understand that all good financial decisions are just life decisions. And that when you're at a stage where you're comfortable with being a homeowner, you probably won't need a spreadsheet to confirm it's a good decision. This has been Principles Personal Finance. I hope you enjoyed that. Thanks for watching. I'll see you next week.